Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome, welcome, welcome. I want to thank everybody for joining us today. My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners, also the host of this radio show, Destination Retirement. Everything that we do on this show and everything we do as a financial fiduciary is to make sure that we are providing you the opportunity to make money even when the markets are down. This is going to be a unique show. Many of you know that we often talk a lot about the tax strategies of our alternative energy strategy, and we have a guest with us on the show, actually for the first time. He's joining us, but if you do want to get on my calendar and have a conversation with me, call Paige at 630-492-1912, 630-492-1912. So let me introduce Richard Loomis. How are you?
I'm doing well. Thank you very much for having me.
Absolutely. So this is going to be a really unique show. We're going to spend the bulk of the show talking about the energy space, alternatives, tax savings, and just see where it goes. Richard, tell us a little bit about your background.
Well, Robert, I appreciate it. I've actually been in the energy space for about 25 years. I was the publisher of World Energy Magazine for 15 years, and that was a publication that kind of hit energy at a very high level. But it was entirely written by all of the CEOs in the industry. So I got an opportunity to meet some of the very biggest, CEO Shell, BP, ConocoPhillips, and others. I've also been a part of my own publicly traded oil and gas company and have really seen this from just about every angle. So I'm pretty excited about what we're going to talk about today.
What do you think in the Midwest? Because you're from Houston.
I am. You're right. Currently from Houston, yes.
Yeah, so in the Midwest, I've always said that the most overlooked area of financial planning is tax strategies, actually reducing individuals' taxable income. In the Midwest, we don't see oil and gas opportunities. Any words of wisdom to the listeners today?
Well, it's interesting. People forget about energy. We know we put gasoline in our cars. We know we flip the switch on the wall and the lights come on. What people don't realize is how we get there. Oil and gas, largest commodity market on the planet. There's a reason for that. And also, this is something that our federal government is highly incentivized to get it right. Because if you don't, the economy stops. It's called industrial oxygen. And therefore, they've put in place a lot of tax incentives to keep the industry rocking. And back in the days when we used to import most of our oil, that was critical to get people to develop it. Now, those incentives can be transferred through to individuals. And most people who haven't been in the oil and gas business before have no idea what that can mean.
Especially, here in the Midwest. And I can honestly say that I think we're the only ones that are bringing this strategy to the table. And just a couple high-level bullet points on why we're doing this. The S&P 500, some of you may know this, but is on track for a new high, even though more NYSE issues are hitting 52-week lows than highs. More NYSE issues are declining than advancing. More NYSE volume is flowing into losers than winners. Over the past 60 years, that just doesn't happen very often. And I think when you look at what the institutions do, they always have a bucket of their money, Richard, that can do well independent of the stock and bond market. Being in energy, and that's pretty much how you've made your career, what are your thoughts on other investments, real estate, stock and bond, or is it just, energy?
Well, no, all these investments are important.
Yeah.
So you just can't ignore it. I think what makes energy unique is it's got a very similar track record. So, we're sitting right now at $80 oil. We're sitting at very low natural gas prices. But if you look at what the demand is, it always goes up. And if you want to invest in a commodity, which is different than investing in stocks or bonds, but if you're going to invest in a commodity, you need to be in a commodity that has a global market, kind of like gold, but this is so much bigger. It's access that counts. Like, for instance, before online trading, it was very difficult for individuals to access the stock and bond markets. But now everyone can.
On your phone, right?
Yeah, on your phone. That's right. But getting into the energy space has always been difficult. It's been the playground of the institutions. It's been the playground of the PE, the private equity money. It's in the playground of the multinational. That would be like ExxonMobil, which, believe me, with its market cap, it's bigger than most countries. So it's been a very tough space to get into. Now, if you're in Houston, where I'm from, you cannot walk down a block without finding somebody that has something to do in the energy space. Whereas up here, you probably just don't see it.
No, so it's very geographical. But one of the things that I think is so critical in what we're doing at Kuhn Capital Partners is, again, we're bringing these types of strategies to the average client. And a reason why, obviously the statistic I just read, but last week was we saw massive outflows for U.S. large cap ETFs over the past week or two. And, the markets, there's just risk, right? And when you look at the energy space, and if you look at kind of financial planning, tax reduction is just overlooked.
In the energy space, we live on the tax breaks. I mean, it's how you get started. Now, what's happening is you look at how they've done the tax incentives. This is what was driving Congress nuts for the last 2 years. Why are we subsidizing the oil and gas business? Well, and the reason we do that is because it is so expensive to get into these deals. I mean, it's very expensive, and a lot of them were not successful in the past. So it made it very difficult, and that's why these incentives are in place. It's also not lost, even on the current administration, how important it is to be able to influence global trends with energy. And, of course, the previous president was better at it, but the current president isn't ignoring it either. And the Democrats that are in charge are not going to eliminate these incentives. And if you look at it, if you're in the energy space, which let's say you have your bucket of stocks and bonds, and you got offsets, and then you look at what's going on in energy, if you can get into the largest commodity market on the planet and use that as part of your strategy, oil prices are at $80, and there are a lot of pressures that are keeping them up. And this is a case where you just got to get into the better spots in the world, which now is primarily the United States, which is good for us, and be in this space with some of your money. There's just no reason not to.
Yeah, and I think we have to, let's set the stage for what's out there today and jump in and correct me if I'm wrong. What I see in the marketplace today, I always tell investors, because I run the KCP Energy Fund, that the tax benefits are not necessarily a differentiator of our fund versus other funds, right? I mean, tax benefits are just good in most oil and gas funds.
Actually, no. Most oil and gas funds don't transfer the tax advantage to the individual. Most oil and gas funds are going to capture that for themselves. And then they're going to be providing a pretty good return for those investors. It's hard not to. I always say, the most profitable company in the world is an oil and gas company. The second most profitable company in the world is a poorly run oil and gas company.
I love that.
So it's really hard to not make money if you are producing and doing your job correctly.
Got it.
It used to be you didn't make money if you kept drilling dry holes.
And that's another thing we'll talk about. But so last year, the KCP Energy Fund per $100,000 invested reduced active and passive income for investors by $90,000 per $100,000 invested. That's pretty darn good.
Well, yeah. I mean, that means that if you invested $100,000, you got to reduce taxable income by $90,000.
Oh, absolutely. And again, we want to make sure that we're very transparent. 90 was high, right? We say to budget for 70 to 80%. But if we can deliver 90, great. But if you're happy with 70 to 80, you're going to be happy with certainly with 90. But when you look at financial planning, if you're working with a big bank or a big brokerage firm, they just don't have access to these strategies. And the quote unquote independent advisors, 99% don't have access to strategies like this as well. So here's what I see that's out there. And correct me if I'm wrong. I'm seeing a lot of opportunities, and then we'll get into kind of our fund and the opportunities, location, et cetera. But we're seeing opportunities in tier 2, tier 3 locations, and it's a small mom and pop operator, and you're living or dying with a single well 2 or 3. Would you say that the bulk of what is available for the individual, that's kind of the profile of the investment?
Yes, that's accurate, and there's a reason for that. This has always been the playground of the institutional money, and this has been where PE is invested. And if you're going to invest in an oil and gas deal, the zeros are incredible. So
we need many of them, don't we?
Yeah, a lot of zeros. So by the time, if somebody has exhausted every access to capital and they're down to the individual, this deal is probably not a deal you want to invest in. That's why this has happened. And it's also why people get burned in the oil and gas space.
Which, again, down south, and, I spent 22 years in Texas, everybody's lost money in oil and gas.
Well, yeah. I mean, it is the playground of the big money. If you don't have big money, then you're investing in sub-tier opportunities because otherwise you wouldn't see them. And It's something to remember. And, with what we're doing here, you're taking advantage of what the big boys are doing.
Yeah, let's get into that. I mean, educate the listeners on the Permian Basin. You and I talk about the Permian. Texas, everybody knows the Permian. Here in the Chicago market, you say Permian Basin, I bet 1 out of 100 know where it is.
if that. I mean, what happened in the oil space in the United States is very interesting. It used to be go north. Well, everybody knew about the Alaska pipeline.
Yeah, we hear a lot of that because obviously we're closer to Alaska.
Yeah, well, okay. Actually, I think you're closer to the Permian than I am in Houston.
Well, maybe. Yeah.
But, when you start seeing what happened in the United States, the Permian Basin, which is located in West Texas and in New Mexico, has become the largest producing basin on the planet. It also accounts for half of the oil generated in the United States.
But why is it then you always hear, Saudis and, that they're controlling oil? I mean, is the Permian really that dynamic?
Oh, yeah. This has made us the swing player. So right now, the United States is generating more oil than Saudi Arabia on a daily basis. And there's a reason for that, and we'll get into it. But what you've got is the United States, because it's private land, this is the only swing player left on the planet. And now we can produce more oil in the Permian Basin than you can in Guar, which is in Saudi Arabia. Now, the lifting cost is very similar. That's how much it costs to get the oil out of the ground. It's $12 to $18. But to break even in the Permian, you only need $42 a barrel. To break even in Saudi Arabia, you need $78.
Why is that?
Well, Saudi Arabia has no private land. They use a national oil company, and that national oil company funds all of their social programs. So if they don't have a near $80 price of oil, they can't afford their social programs. So they have no incentive to try and push the price of oil down. The United States is different. We don't like high oil prices, but we also are in a position to take advantage of them. And as we've seen in the Permian Basin, when a basin is that prolific, that's where the majors go. They don't need to play internationally in Nigeria where their crews could get hijacked. They can play right here at home, and that's what we've seen. The majors have migrated into the Permian Basin. It's 75,000 square miles of production, and literally it's out in the middle of nowhere. If you go to the Permian Basin, all you will see is tumbleweeds and oil wells and windmills.
Friday Night Lights, right?
Yeah. I mean, that's the only civilization out there, and that's Midland, Odessa.
Yeah.
If you go to Pecos, it doesn't even have a public airport.
Oh, my goodness. Yeah, and I think, again, throughout the show today, it's our job to kind of overcome some of the preconceived notions that you're gambling when you're investing in oil and gas. So I want to thank everybody, obviously, for listening. This show is unique. We have a guest on, and everybody who has listened in the past, who has come to a dinner, current clients, you do know that our job is to make sure that we are providing strategies that are very, very high level, strategies that are hard to attain, strategies that can deliver independent of the stock and bond market, strategies that can greatly reduce your taxable income. So if you want to get on my calendar, give Paige a call, 630-492-1912, 630-492-1912. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, KuhnCP.com. Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com.
Welcome back. I want to thank everybody for joining us this Saturday morning. My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners, independent registered investment advisory firm. If you're catching this on the podcast, thank you. If you're listening live, thank you. On the podcast, we see the numbers going up and to the right. My only ask of you is if you find any value in what we do on a weekly basis here, make sure that you send the link on to somebody that could benefit from the show. We do have Richard Loomis with us today, strategic partner to the KCP Energy Fund. He is enlightening us folks up here in the Midwest on oil and gas investing. So Richard, let me give a phone number out first. So if you do want to get on my calendar, give Paige a call, 630-492-1912, 630-492-1912. Tax benefits. It's funny, if I just said reduce your taxes, I bet we'd have 15, if that's all I said for an hour, I bet we would have 15 people, 20 people call and say, hey, how do I reduce my taxes? And again, last year, if you'd invested in the KCP Energy Fund, you reduce your taxable income, active or passive, because that's a big, significant difference. So you can reduce active and passive income, but you reduce it by $90,000 per $100,000 invested. Again, that's just one component. We have to go over what the investment is, which we're going to do that throughout the show today. And if it makes sense for you, we have to discuss the risks, the considerations, and everything. But we're bringing to the table something that is totally unique, especially here on the radio. I promise you, if we talk to a consultant and asked them, should we talk about energy or oil and gas investing here on the radio, they'd say no. But you know that we're different. We want to make sure that we're cutting edge, and we're going to bring you strategies that can impact your tax savings and your portfolio. So Permian Basin, to you and I, second nature. Why the Permian? Why are the majors in the Permian, and what exactly does it mean for this fund?
Well, if you look at the oil and gas business, it used to have the moniker of bust and boom. So you either are losing money or you're making money depending on the price of oil. Well, that doesn't work for multinationals like Exxon, Chevron, ConocoPhillips, BP. They go to areas where there's a whole lot of oil. That would have put them in the past into Nigeria, in with Saudi Arabia, dealing with Aramco, all of the Middle East, Africa, these areas. They were multinational companies. As the independents played with the Permian, those were the companies that are solely on the production side. So this is the Devons. This is the smaller of the majors. Well, as they started to discover how to make the Permian work, it became a manufacturing operation instead of a wildcat operation. As you start to get more than 50% of your wells successful, you start to figure out the geology. And what we figured out about the geology in the Permian is it's really hard to screw it up. Think about it like a stack of pancakes. You got 15 different layers you can develop oil from. What this did is it attracted the majors. Because would you rather work in Nigeria or would you rather work in the United States?
Clearly.
And so what ended up happening is the majors came in and started buying up the independents. And what it did was it took all of their assets, thousands of geologists and engineers and production specialists, and they came in and figured out how do we manufacture oil wells in the Permian for maximum effect.
So it's kind of like it's an assembly line of some sort, right?
That's really where it's gotten to. Yeah. So there's still dry holes drilled in the Permian. But if you do that, you get fired and another guy gets assigned to the job. So the guys that are working in the Permian are highly incentivized not to do a science experiment, do what works, and to keep this thing going. So the Permian has become the gift that just keeps on giving. Every time we come up with new technologies that can be applied in the Permian, it's the best place to do it. It's literally the best rock in the world, and it's the largest oil field in the world.
So the runway is significant.
Oh, yeah. And so what happens is you get guys like ConocoPhillips, guys like Chevron, guys like BP. They come in, they buy the independents, they take them out. Now, the independents chase high oil prices. When the prices are high, they want to put as much money as possible toward trying to get oil out of the ground. The multinationals are not that interested in that. They look at this as the 30 to 40-year operation, and they're not as sensitive to the prices. So what they'll do is they put their budgets together, they activate them, they go on process, and they continue to produce oil. What that does is it creates a very, very stable environment for investment. You know exactly what they're going to do, when they're going to do it, and for how long are they going to do it. However, access has always been a problem. If you go into ExxonMobil, knock on the door, and say, hey, I want to invest in one of your wells, they would very polite say, thank you.
Yeah, thank you, but no thank you.
Yeah, you can go away now.
Yeah, right.
Come back and see us later. Buy some stock.
Yeah.
And so the access has always been difficult, and the Permian is highly aggressive. So to get in, you have to either buy mineral rights, you got to buy land, you got to take out leases. It's all speculative.
Yeah.
May or may not happen.
Millions and millions and millions of dollars.
Yes, exactly.
Yeah.
Now, in our strategy, we took that off the table. We're not playing that game. In the strategy we're implementing here, we're going heads up, which means we're investing at the wellhead with some of the largest companies in the world.
And I think we need to talk about that because, you've heard me often say that the KCP Energy Fund and really the strategy that we're doing is one of one. And meaning that the strategy is not new. It's just new to the individual. You look at oil and gas investing being a niche and then getting into the Permian for a minimum investment of $100,000. That's a niche of a niche. And then you're partnering with the Exxon Chevrons and, as you say, investing heads up with them. I mean, it's a niche of a niche of a niche. And so it's our job to really articulate to individuals that this just is so unique and why it is so unique and why it is so de-risked, even though there is commodity price risk, of course. I mean, this isn't risk-free. But, when you look at exactly what the fund is, I mean, what do you think as far as, why should somebody consider it?
Well, I mean, you should consider it because it's the largest commodity market on the planet. So if you want to get something that's outside of the market and something that really lives on the greatest demand on the planet. I mean, you still got 1.2 billion people that have never seen power to their house.
That statistic is just crazy. And you know what? When I say why should people invest in it, I mean, the reality is if you have a diversified portfolio, I bet 15 to 20% is in energy stocks.
Oh, undoubtedly. I mean, because it's literally the largest commodity market on the planet. And you also look at the demand. So demand is consistently rising. And I know we hear a lot about electric cars and Tesla. We hear a lot about electrification of the transportation space. But still, 90+% of our transportation here in the United States is run on gasoline, hydrocarbons, even hybrids, and even electrics have a high component of hydrocarbon in them because they get their power from natural gas.
Yeah, and it's obviously not going anywhere. And I think, So when you're looking at an oil and gas deal, and when we did our due diligence, really what jumped off the page was the Permian.
Oh yeah, I mean, if you're going to find oil, go to the place where oil has been found. You don't want to have a science experiment. The other thing you want to do is you do not want to invest with somebody who is small. This requires a big balance sheet. And you also want to invest with somebody who has discovered a whole lot of oil.
Yeah, and that's the Exxon Chevrons of the world. I think what, in our conversations, Richard, with individual investors, is they need to understand what it is exactly that we're doing. So we've got the location down. I think we've hit that. We're coming up against a break here. I think in the next segment, what we really need to do is to really take a deeper dive into exactly what the fund is doing and who the partners are. And, we'll go through that, at the next segment. So stay with us. But you are listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. If you'd like to get on our calendar, learn some more about the energy investment, or we're not talking about our structured notes this week, but we still have had phenomenal structured note offerings from the big banks. If individuals want to learn about how you can deliver positive returns in down markets, you know that we are the group that you need to discuss that with. Our job is going to be to educate, not sell. We are selling education. We are very, very passionate about giving you the same expertise that the advisor that you're probably working with is using for their own money, yet they are not. It's so crazy in this industry. If you look at an advisor, how they manage their money, 9 out of 10 times, it's my personal belief that they are managing their money totally different than how they're advising their clients. And so we're trying to change that. 630-492-1912, 630-492-1912. More after the break. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm. We are trying to give you and afford our clients and listeners in the Chicagoland area the same strategies that advisors use for their own money. It is my belief, again, as I mentioned at the end of last segment, that 9 out of 10 advisors are managing their personal assets, their family assets differently than they are advising clients to manage their own. And that's a mission that we are on to change. You can make money when the markets are down. You can greatly reduce your taxable income. Those are the things that we are working on. That is why clients and listeners reach out to us. So if you do want to have that conversation, just give Paige a call, 630-492-1912, 630-492-1912. We are reinventing the asset management, the advice business, and we are very, very passionate about that. So we do have Richard Loomis with us today. We are going over energy investing. We're going to dive into the KCP Energy Fund with the remainder of the show. So far, we want to be where oil is. Richard, you mentioned that. What exactly are we doing?
I mean, we talked about how, the majors have moved into the Permian Basin. And the majors are very, very well funded. So the idea that you can come in and invest along with them is kind of an anathema. It doesn't make sense. But when I started looking at getting back into oil, we're at $80 oil. So to get into the oil market right now is very, very difficult. And when we uncovered this strategy, it's pretty basic. You see, the oil and gas industry operates on leases. The leases are provided by the landowner. The landowner leases the opportunity for the person to drill, and it actually runs in a block. So the grid is laid over the land. It's literally a block. But people don't buy land in blocks. So on that particular block, you're going to have somebody that owns the majority of it. Let's call that one Company A.
Okay.
The remaining part of that block could be owned by 2, 3, 4, 5 others, all minority owners. But the one who owns the major portion of the block gets to the drilling schedule. So let's say Company A contacts all the minority owners and says, hey, I'm drilling. You own 10%. So you get a choice. You can either pay the 10% to receive your 10% of the production, or you can decline. And the reason you would decline in today's world is because if Company A is Chevron and Company B is Occidental, Occidental is not in the business of supporting Chevron's drilling program.
Why don't we give an example, a real live example of the ConocoPhillips deal that is now ultimately going to be closed on hopefully in the next week or two?
All right, so here's an example. ConocoPhillips owns the majority of the drilling block. ConocoPhillips goes to Occidental and says, hey, you need to put up your share. Occidental is operating under this new philosophy, which is fiscal responsibility. And in fiscal responsibility, they're not following that boom and bust. We talked about that before. They're a multinational. They can go only where they feel the best quality oil is, and they're going to produce it over the next 30 to 40 years. So Occidental looks at ConocoPhillips and says, I'm not really interested in investing in my competitor's drilling program. They're more interested in putting cash on the balance sheet, buying back shares, and drilling their own wells. So in the past, they had two choices, say yes or say no. And they would have done it because cash was free. They could get lots of money, and they would say, fine, go for it. But in this particular case, we're purchasing 6% of 6 wells. Now, 6% does not move the needle for Occidental. But they have now got a third option. They can say yes, they can say no, or they can sell it to us. And what we're buying is that little overlap. So we're buying the 6% that Occidental owns, but they don't want to capitalize on. Now, they get some value for it because we're buying it.
Of course.
But this puts us in the same position as ConocoPhillips.
And it's important for people to understand when you say heads up, literally investing directly alongside of a company that probably has, what, 80, 90, $100 million in the 6 wells?
Or already is $84 million that they've invested in this program. And here's another thing. You don't want to invest in a drilling program when you don't know when they're going to drill. You could invest in a program that might drill in 2 or 3 years. That's not our situation.
Absolutely.
We want to look at just before the drill bit. So this investment with ConocoPhillips, they've already started drilling 4 of the wells we're going to be invested in. When they're finished, we'll be receiving our production.
And so that is called a non-operated working interest. And so in its simplest form, we are finding opportunities that you're the minority owner and you're leveraging the balance sheets, the expertise, not only of our team, but the team of Exxon. And I think they know what they're doing.
Yeah, we would hope so. I mean, ConocoPhillips has drilled thousands of wells.
Yeah, absolutely.
I mean, thousands of wells in the Permian. They understand the geology, and they wouldn't put $81 million into a program if they weren't pretty sure it was going to be successful.
How many programs do you think that they have in a given year?
Oh, good Lord. It's huge.
Yeah.
The drilling budget for ConocoPhillips is close to $1 billion.
Yeah, I bet
so
more.
They got a bunch of money they're going to be spending. I'm talking about U.S. only.
Okay.
So, it's a lot of dollars. They also have a lot of bodies. Now, here's kind of what's interesting about this. They've already started drilling. And when we look at this opportunity, we look at all of the wells they've drilled up till now, within a 5-mile radius.
I mean, can you believe the software that's out there? You can get as granular as you want as far as information.
Oh, yeah. I mean, once we've identified an overlap and we've identified an opportunity, we go in and we look at all of the geology associated with it, and we look at all of the wells that produce around it, and we look at what the company is telling us. You guys are saying that it's going to do X, and then we make our own assessment on whether it's going to do it or not. And not every well that ConocoPhillips puts on the market are we going to buy.
It really, because it has to fit the economics of ultimately the fund.
Well, that's right. But not only that, it has to be drilling now.
Gotcha.
So we don't want to drill something, even if the economics are phenomenal. We don't want to buy it if it's not drilling now. We'll buy it later. So this is a case where we're coming in, and this is why the tax benefit is there. Conoco is spending a ton of money to do this project. They need the tax incentives. The other thing is we get charged the exact same amount they charge themselves. And so ConocoPhillips is only charging themselves the same thing they have to charge us. So whatever they paid for the rig. And here's an interesting fact. Whether it's $100 oil or $60 oil, the cost to drill the well is the same. So when we get into these deals, we're not worried about the price of oil. It's taking care of itself. What we're doing is we're looking at what's the budget. And we want to work with operators like ConocoPhillips that are always under budget and get their job done faster than they've told management.
Yeah, and that's what the KCP Energy Fund is. I mean, the KCP Energy Fund is, working in the best rock in the world, certainly in the Permian Basin, partnering and investing directly alongside of the industry majors in projects that could be 2 wells, could be 6 wells, could be 8 wells, could be 5 wells, and then having that level of diversification. And what's out there today is, again, science experiment, so tier 2, tier 3 location, small mom and pop operator, and then you're at the mercy of 1 or 2 or 3 wells. Talk a little bit about, Richard, kind of the marketing of oil and gas. I see deals, you see deals all day long. Every single deal I see on paper with glossy brochures looks like it's going to be a home run.
Well, of course. Of course. I remember there was a gentleman named Van Dyke. He was the head of Vanco, and he was a great salesman. But I remember watching him walk all the way around the room showing charts and this and the other. And he said, so we believe there's millions of barrels of oil here, or it'll be a dry hole.
Oh, wow.
And so, and that was a deal that was in Gabon, I think. But every deal you see, by the time you see it, it's been picked over. And I'll tell you what, you're not going to see a Facebook ad to drill a well with ConocoPhillips.
Oh, yes, you are. You're going to see that Facebook ad with the KCP Energy Fund.
Oh, there you go. Okay, so that's new. That's new.
But seriously, though, I mean, because you look at, like, cost of capital, right? And you look at when you guys, so we've had a working relationship since 2016, 17. And, when one of the things that made me feel very comfortable in setting up the fund and creating the KCP Energy Fund was kind of the private equity nature of the team and what they had done in their past lives, what you have done in your past lives, what a couple of the other principals have done in their past lives. Because, yes, the fund is new, but the expertise, the strategy, it's not new in any way.
No, that's correct. Non-operated interest, and we probably should talk about working interest a little bit.
Yeah, give people kind of just a background of that as well.
Okay, so in a typical drilling deal, you got the mineral rights owner, the landowner. Those individuals are going to carry about 25% because they own the land. But the mineral rights and the royalty owner are then supplemented by the working interest. Now, the working interest is divided between who actually runs the operations, that's Conoco, and then the non-operated. Now, the non-operated interest owner puts up his cost of the expenses and receives his percentage of the production. Now, in the business, we call that mailbox money.
Isn't that what everybody wants, mailbox money?
Mailbox money.
Yeah.
And, so what ends up happening is you put your piece of the expense up. Notice, expense. You're not putting up the dollars to buy the reserves. The reserves are yours because you are the minority working interest owner. The working interest is where the actual production goes. So when that production comes out of the ground, ConocoPhillips is going to be the one selling it for us. So they get the best rig rates, they get the best geologists, they got the best cost structure of anyone in the business. It's very highly motivating to get your mailbox money from them. They also have great accounting programs. They've got the best balance sheet. So they're not going to go somewhere. If you get to one of these deals that you're talking about in a tier 2, and the operator goes out of business, unless you're planning to get into operating your interest, you're in a world of hurt.
Well, and that's just, but I see what opportunities are available. And I see what opportunities are available for listeners who want to allocate 5%, 10%, 15% of their portfolio to these deals. They are exactly those deals that we want to stay away from.
Well, yeah, and I don't want to denigrate those guys that are doing those deals. They might get lucky.
Well, and that's what I tell people. I mean, because our targeted return is 15 to 20% a year. When you look at the other deals, many of the deals are marketed as 30, 40, 50, 60%. So we don't want to say those deals are bad. They're just a totally different risk reward and a risk return profile as well.
No, that's true. If you're doing a science experiment and you're phenomenally successful and you've figured out how to make gold out of water, okay, you're going to do very, very well with that one. But if you don't want to get into a science experiment, if you want to go where the oil's already been found, sure, the returns aren't as high, but at least you're getting the returns.
Well, and that's just it. I mean, you listen to Warren Buffett, you pay for predictability. And in this instance, maybe the returns aren't quite as high, but who in the world is not going to accept 15 to 20% targeted returns?
Well, I mean, I will.
I mean, I absolutely. And it's, because when we look at those deals, I always look at, because we see a ton of deals that are independent that, people are trying to raise capital for. And those deals are in the $2 to $4 to $6 million space. And like you said, if they're that good, they probably, if they have any level of success, should be able to personally fund that deal.
Yeah, well, yeah. I mean, but again, it's looking at the quality of the deal.
Yeah, and that's it.
When we look at the deal, we're looking for a deal that has a set budget, but we also want to know that the operator is typically on budget. If you're dealing with one of these smaller operations, they don't have the history.
No, and they can tell you anything they want to tell you.
Of course, but if you've got ConocoPhillips that's drilled thousands of wells in the Permian, I got a pretty good idea that they are going to know how it's going to cost. Yeah. And then you want to look at timing. Do we know when the timing is? Typically on the smaller deals, they have to raise the money first. This did not need the money raised first. ConocoPhillips has the money. That's not the issue. In their case, it was trying to get the minority interest owners all in alignment so that they know who they are and who they're going to pay. That's a great place for us to be.
Absolutely. And one of the things that in talking with individuals who are considering investing in we're obviously raising, the fund raise is $50 million, and we hope to have that secured by end of year. But everybody asks, why are ConocoPhillips, BP, Exxon, Chevron, et cetera, why are they selling deals down? And we have to make sure that they understand that they are not selling the deal down.
No, you're right. I mean, they'd be perfectly happy if Occidental had said, we don't want to participate, you guys take it.
Yep.
And that would have made ConocoPhillips just thrilled.
Yeah, absolutely. And so we're not selling the deal down. And so what we're doing is we're focusing solely in the best location, partnering with the best operators. And then when you have a $50 million fund, what do you think, what would your guess be if we fast forward to that $50 million is deployed? I don't think it's unrealistic to say we may have 40 to 60 producing wells.
Well, look at it this way. Our first deal, which
Yeah.
we did last year, 6 wells.
Yeah, end of last year. Literally came together almost overnight.
Yeah, pretty close.
Yeah,
I mean, these deals are so prolific that if you can look at those overlaps, you can pick and choose. It's like being a kid in a candy store. But that was 6 wells. Now the ConocoPhillips is 6 more wells.
Yeah, so we're at 12.
That takes us to 12.
Yep.
I mean, and we'll do another couple of deals this year. And so, yeah, we're at 20, 30 wells.
Yeah.
And that's critical. When you look at the smaller deals, it's 1 well, 2 wells. This is multiple wells and multiple operators. The first one's operated by Matador, about an $8 billion company. The second one by ConocoPhillips. The third and fourth deals will be other operators, most likely.
Yeah, and so in that, again, when we look at stocks and bonds, right, we have this analogy of, you have to have a balanced portfolio. And again, look at the bond market. Bond market's in the fourth year of the worst drawdown in history. Why in the world is an advisor not bringing strategies to the table that can do well when the markets don't do well? Because wouldn't you say that the returns of the distributions of the fund, they're not dependent upon the stock and bond market?
Well, no, I mean, there's a little bit there because ConocoPhillips is a publicly traded company.
Absolutely.
Which means if they started drilling dry holes, their stock price would go down.
Yeah, you bet.
They're highly incentivized to make sure they do their job right. But you look at the Permian, and the Permian as the most prolific basin is going to be the last basin you would turn off and the first basin you would turn on in these ups and downs.
Well, or even during COVID.
No, I realize they didn't stop drilling in the Permian, and that's primarily because the majors had moved in. And the majors really don't care. They're not nearly as focused on the price of oil as they are on global demand.
Yeah, they're not worried about debt covenants like many of the smaller companies are. And I think that's our job. Our job is to bring something unique that can greatly reduce your taxable income, but again, that has a high level of predictability of success. That, to me, is very, very critical. Because even talking with family members, it's, first question always asked, what if the well doesn't work out? And they're just meaning, a dry hole. And, again, we have to talk about the Permian, the operator, but not only that, the level of diversification of the fund is that, like you said, well, I don't know if you said it or not, but we've coming up against a break here, but underwriting, the first 6 wells came in of the first asset, 50% plus or minus more production than we anticipated.
Well, yeah, in the next clip, let's talk about that.
Yeah, let's talk about that. You are listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. As you know, we are here to educate. We're here to help. We're here to make sure that you have the same strategy that access to that Wall Street uses, that advisors use for their own money, for their family money. Give Paige a call, 630-492-1912, 630-492-1912. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, KuhnCP.com.
Back. You're listening to Destination Retirement. Thank you for joining us this Saturday. We are having dinners throughout the Chicagoland area throughout the summer. Those dinners are generally on a wait list within a day or two. So if you have any interest in learning about strategies that can do well independent of the stock market, strategies on how to greatly reduce your taxable income. Last year was $90,000 per $100,000 invested. That is active or passive. We are doing dinners throughout the Chicagoland area. Get on our calendar, get on our distribution list of where and when those dinners are. And if you want to have a conversation with me on the KCP Energy strategy, the structured notes, our equity strategies, you know that you just call Paige at 630-492-1912, 630-492-1912. to 1912. Richard Loomis was kind enough to fly up from Houston. Richard and the team are at the dinners. Again, we are very excited about the strategy. The uniqueness cannot be understated. And so the KCP Energy Fund is investing literally directly alongside of the majors. Majors are BP, Occidental, ConocoPhillips. Being able to invest directly alongside of them where they are funding the majority of the deal and we're just a minority owner. The uniqueness, as I just said a second ago, is so critical. So Permian operator, level of diversification. Let's talk about the kind of a little bit on the underwriting and the first deal that really almost came together overnight, end of last year, the Matador deal.
Well, and let's talk about how we do this.
Yeah.
So if you were to go to the Permian Basin.
Well, let me interrupt you real quick. I think that's so critical because these deals, generally speaking, are off-market private deals. Touch on that as well.
Well, I mean, we've talked a couple of times now about what kind of deals you actually see. When you look at the Permian Basin, and if you were to put it up on the wall, you would see thousands and thousands of little dots. That's how many wells are being drilled out there. If you were to look at that and try to decipher which ones you want to invest in, that would take years just to get your arms around it. So when we look at the Permian Basin, we try to figure out, all right, where are the best spots? And that's going to be the Delaware Basin and the Midland Basin. Then we high flight the operator. We want to find somebody who is doing these things on time and under budget. Then we look at those overlaps that I've been discussing. We try to figure out where are those minority owners that might be willing to sell. And then through the relationships we've already got with them, we've been out in that area for a very long time, we start looking at which ones do we want to buy. And then we come up with what the value is. So when our team looks at what ConocoPhillips says the wells are going to produce, we're going to evaluate that based on the wells around it. Now let's talk about the Matador deal. When we looked at the Matador deal, we knew that field was a good field. We anticipated that those wells that they were saying they were going to drill, and 2 of them have already been drilled at the time, so we figured 750 barrels a day per well. When these wells were completed and put on production, we got 1,100 barrels per day, which is not unusual for Matador. Matador will typically give you a lower estimate, and we haircut that. Then they also will give you a time period, and they try to beat it. And then they will give you a budget, and they try to beat the budget.
And also, just having access to that deal was a value add that our partners in our fund can bring to the table that just simply most don't.
Oh, you're right. I mean, in just over the last year and a half before we did this, our team had seen over $3 billion in opportunity in these little tiny overlaps. And so when you look at that deal, we spent $2.7 million to take our 2%, little tiny thing, of 6 wells.
Hey, tiny adds up, man.
Wait till you hear this. Under our estimations, that little tiny 2% should generate somewhere in the range of $300,000 a month in gross income. That equals out to $1.5 million a year. So 2.7, and within 12 months, you got more than half of it back based out of the production.
That's amazing. And I think, when we talk with individuals, we're playing in a space. We have the institutional PE type underwriting. We're partnering with the largest operators in the world that have obviously their own team. But generally these deals, I don't want to say they're overlooked, but they're certainly overlooked when you have to place $200 to $300 to $400 million on an annual basis, don't you think?
Oh, yeah. I always say this business has more zeros than anything else I've ever seen. Yeah. But think about this. I mean, in 2006, me and some other guys launched Buccaneer Energy.
Okay.
Now, this is a publicly traded company, and we ended up in Alaska, of all places. And we were spending millions and millions of dollars. But we had some 60 employees. We had 10 geologists. We had 15 people in the accounting department alone. If this had been available for us 4 guys, we never would have launched Buccaneer. This is the type of thing that is a game changer for us, but it doesn't move the needle for Occidental. Occidental looks at the 6% that we're going to buy from them, and that is more of a hassle than anything else.
Yeah.
So they would be inclined in today's economic situation where capital's not free anymore.
No.
And where they're being held to task by the market, they need to invest in their own drilling program. They need to be putting cash on the balance sheet, buying back shares, really becoming more responsible in how they approach their business, not following boom and bust.
And that's so critical. And we've hopefully have given individuals or listeners today a very high-level overview of kind of the investment, the energy space, why it's so unique, why it's so different. And we look at energy investing or alternative investing as kind of a 10 to 20% allocation of a portfolio. If you look at endowments, institutions, et cetera, they may be upwards of 30 to 40%. But we have to have something inside the portfolio that is not 100% reliant upon the stock and bond market. And when we can greatly reduce your taxable income, now, we are not CPAs. I am not a CPA. I'm not giving tax advice. It's always best practice to speak to your tax professional and just confirm, kind of what we are giving you as far as education when it comes to tax benefits. But when you can give somebody last year, 90%, $90,000 per $100,000 invested tax benefit. So if you sold a business, a building, you're a high wage earner, you're a doctor, you're a physician, you just make a bunch of money, and you bring to the table an alternative, and you bring to the table return characteristics that are targeted to have 15 to 20% distributions, you can see why we are just not sleeping at night with all of the educational meetings we're having, right?
Oh, yeah. I mean, one of the things that's interesting to me, because I'm from Houston, I know a lot of people in the oil and gas space. What's exciting about this is we're able to bring people who've probably never been exposed to it. And, you're talking about a $50 million fund.
It's very small.
Yeah, well,
First fund.
In this industry, that doesn't move the needle.
No.
But it sure moves it for us.
And it sure moves it for individuals, which is what matters, right? To me, that is what is so critical is, what are we bringing to the table that other advisors are not bringing to the table? And again, Richard, we're coming up against the end of the show. We probably could go for hours, but I do want to thank you for coming on. And any last words of wisdom to the listeners here in the Chicagoland area?
Well, I can tell you this. Oil and gas prices, they go up and they go down. But they're very rarely zero unless we have a pandemic. So this is something that is the gift that just keeps on giving.
Yeah, and I love that. And that's a great way to end it. And so, we did talk about a singular strategy, which we normally don't do on the radio show. But when the tax benefits are this strong, when the market is at the high level that it's at, when individuals need cash flow, and you look at what advisors are bringing to the table in the 2 to 3 to 4 to 5% range, 6% range, I mean, again, the return characteristics of the KCP Energy Fund are targeted to be 15 to 20%. We're very confident that those will be met. And even if they're not met because, the world slows down or oil prices are a little bit lower, like Richard said, oil prices are never zero for any length of time. I guess we have to caveat that with COVID. So we just have a very high margin of safety in the investment. And that's what we look for when we are investing assets. Doesn't matter if it's in the energy space, because, again, this is 15 to 20% of a holding for many of our clients. There's a lot of other strategies that are out there. But what we have done at Kuhn Capital Partners is making sure that we let the upmarket strategies take care of themselves. We want to focus on strategies that can deliver positive returns even in negative markets. And that's something we're passionate about. So if you want to get on my calendar, if you want to have a conversation with us this week, give Paige a call, 630-492-1912, 630-492-1912. Everybody have a great week, and we'll be back next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.